It's January 31st. This is, of course, the video like it takes 30,000 to a million. Well, after I review the account, I'll be talking about my personal risk ranking of all the different types of assets that you can buy on a regular brokerage account. And then I'll rank my account from like 1 to 10 on how risky I think it is. And after that, we'll talk about options for a little bit and how you can use them to increase or decrease the risk of your account. Although I've talked about that a lot, I'm just gonna shed some perspective on it. So anyways, without further ado, let's go into the account. I've had a monster of a day, one of the biggest on record. So I'm up $16,000 in 300, making up quite a bit of the ground that I lost over the last, I don't know, month or so. Up 9.3% in one day. It's mainly due to things like Alibaba and VIPS, VIP Shop. I'm going to go through the options first. I'm going to quickly scroll through them. I'm going to show you the ticker. This is the price of the option, whether it's put or a call, expiration date, number of contracts, and whether it's a buy or a sell. Now, if you don't know what any of those things mean, don't worry too much. I'll show you the equities in a little bit. This is not that big a portion of the account, probably about 8 to 9%. It's just option plays. Most of them are like long-term options, call options, so they're almost like leveraged stocks. You can think of it that way. So on the right here, you'll see the daily change in percentage and in dollar terms of each play. You can feel free to pause the browser at any moment to try to figure out the exact position. This is all the information you'll need. So a lot of it came from these BABA options right here. So this is the equities. Apple was up 2.39% today, stacking on top of Friday's gains after the extremely optimistic and expectation crushing quarter that they had. So I have EBIX here still hovering around the $30 mark. JD had a really nice day at 7.7%. VIP Shop had almost a 13% day. This is where most of the gains are coming from these companies. So China really stealing the highlights of today's action. And then realty income. I was forced to buy Goldman Sachs at $350. So you see that I have 100 shares extra of Goldman. I used to have 25, now I have 125. And I'm selling options against Goldman for kind of like weekly income of about $300 to $400. So the latest option I've sold, if I scroll back up, why don't I just click on it? I just sold one today for about $390, and so far it's gone against me because Goldman Sachs kept appreciating after I sold the call. It's a covered call option, so I'm sitting at 455, but hopefully it expires worthless by the end of the week, and if it doesn't, I'm just going to sell the options back at 300. I'm sorry, sell the stocks back at 355, which I'm totally fine with. I don't need that much Goldman in my life anyway at this point, although I do think that the company is a bit undervalued, and I think they're very strong. I'm just too leveraged at this point. Like, you'll see the account tab in a second. Let me just go back and finish off the equities here. So I have Mainstream Capital tacking on a couple $100, up almost 3%. Visa down 1%, no big deal. And Smith & Wesson up 2.5%, $84. Now this is the tab where it gets a little impressive here, okay? The investing tab. Boom, $300,000 in management right here. Assets under management, 300,000. So the big reason for that is that my leverage increased I'm now borrowing $105,000 plus because of this Goldman Sachs purchase. It's still a relatively okay percentage of the account, though. It's 35.56%. It's a bit high for me at this point, since the markets are fairly high still, but it's manageable, I think. It definitely adds a lot of risk to the account, and that's what I'll talk about in a second. So this is probably a record at the moment, $300,000 including borrow money. Now, these are my current positions ranked by total return. You will see that Apple is at the top, and mainly the long-term positions have performed the best when it comes to total return. I've sold a lot of positions, and I've only kept really Apple and Realty Income and Mainstream Capital for over a year, maybe Visa. Everything else is kind of new, and or I'm doing options plays or something like that. I have basically sold out of all other positions except these core positions that I'm going to be sticking with. And again, my core positions here are Apple, Realty Income, JD for a while, Main Street Capital, and I'm planning on having Goldman Sachs and maybe Visa be some of my cores. Everything else I'm looking to get out at good enough price. So that is the account here. You can see very healthy gain. 1 week chart is looking pretty good too, 12.14%, $20,000 recovered. This is the 1 month chart, my all-time high of 201,525. Hopefully will be reached soon, but no promises. The only bad part about this leverage is I'm actually paying quite a bit in interest now to maintain it. Probably paying around $150 per month to maintain this kind of leverage. So that adds up to quite a bit of money. Luckily, my selling of options is helping to offset some of that cost, but it is quite hefty, and it does increase the risk. But then at the other side of the coin, I could experience gains like this. I mean, 9% in a day, for example. All right, 3 month chart, 3.14. I don't know what's going on with this chart. 1 year chart, $40,000, 28%. Okay, so that's the account. Now, what I want to talk about next is risk, and I have my own risk ranking of how I think about all the different asset types that you could buy on a typical brokerage account. Now, if you go, if you Google it, there's some standard risk curves definitions out there, and they're somewhat similar to what I use or what I think is more or less risky, but it's not quite the same. So I'm going to share that with you, and then some of the reasoning behind why I place certain things in the order of risk, and I will then rate the account, my account, as to how risky I think it is on a scale of 1 to 10. See how that goes. So I'm going to pull up this thing that I've prepared, but I have to zoom it out a little bit. Anyway, I'll just go like this. So risk rankings, and these are it. So some of the riskiest things you can buy, I think, in my opinion, again, just remember, this is just my opinion, right? It's not like standard textbook accepted investment dogma. All right, so I think some of the riskiest thing you can do in a brokerage account is just straight option plays. So what does that mean? Well, that means like calling put option, buying straight call options, selling straight call options, buying straight put options, etc. I think that's very risky because you give yourself a bit of a time period, and then basically it's over. You either win or lose. I mean, if you enter your entire account into a call option, that's like it's very risky. You have less than 50% chance of winning, and you could get a big reward, but you could get a small reward. You could get no reward at all, or you could even just lose all your money, right? If your whatever underlying asset you were buying an option against goes below your strike price, that's it, you're done, right? You lose everything, all of your premium, all of your cost. It's gone, never to be recouped again. You own nothing. So I think it's very risky. Options also represent 100 units of the underlying asset. So it's not quite 100 to 1 leverage, but it's close in some cases. You can look, I'll show you something cool here. If you didn't know this already, let's take this short-term BABA put that I bought today. If you look at the delta, you can't see it on the account. You can kind of see it on the bottom left. If you look at the delta, that will give you a number that represents how much of the movement on a day-to-day basis this option kind of represents relative to one share of Alibaba, for example. So since you're buying 100, it might contribute like 24% of the movement of 100 shares. Let's put it that way, if that makes any sense. So like if it's 100 delta, then it would match 1-to-1 the movement of 100 shares when it comes to price action. Does that make any sense? Like if let's say Alibaba was 100 and it goes up 1% to 101. If you have a call option, let's say you bought a call option of Alibaba with delta of 50, then that call option should match 50% of the move, 100 shares. So that would be like, could go up to like 150 or something like that. I don't know. Whatever the premium is. But anyway, I'm getting a little bit off topic here. So the second most volatile item here on the list is high volume, low float, small cap, volatile growth stocks. It's a bit of a mouthful, but if you get like some small company basically that tends to move a lot, it has a lot of attention on it, and it doesn't have many shares that are traded on the exchange, and people are actively participating in it, that stock can move up and down very, very rapidly, and you could lose all your money real quick. You could make a lot of money real quick, but the stock can also even go down to zero. So I think that's probably the second riskiest thing you can do, or hold in your brokerage account. Third, or number 12, coming in is high leverage, illiquid, small cap stocks, funds, or ETFs. So similar to the small cap, this is just ETFs, funds, or stocks that are just not very big and they don't have a lot of liquidity, but they have high leverage. Those things can tick up and down, very quickly, and you can have wild swings that are irrecoverable. Sometimes the structure of these products is such that you're meant to lose over the long term, so they're only used as kind of like daily trading products for daily trades. Number 11, commodity producers, juniors, and then majors. So those are things like gold miners, oil diggers, oil explorers, things like that. So anything commodity related, I think it's pretty risky. So because commodities actually tend to trend down in real terms, at least over the long term, because humans tend to, through innovation and other means, tend to actually increase the efficiency at which they output raw materials, and that increase in efficiency is greater than the population growth of Earth, and so that would automatically force commodity prices to go down over the long term by some margin. So I think although there are commodity spikes out there, and right now, especially in an inflationary environment, they could provide as a good hedge against inflation. They are very risky to deal with. The swings are wild, and they're very prone to supply shortages, etc. So they're unpredictable. A lot of things get priced in real quick, and you could win or lose a lot of money. And also over the long term, you're basically guaranteed to lose if you hold just like a basket of commodities versus, let's say, tips, which are inflation protected treasuries. So inflation protected bonds, basically. All right, moving on. Number 10, unprofitable growth stocks. So these are like, the Pelotons and DocuSigns of the world. Okay, the Palantirs, and I would probably put all the meme stocks in here, or like weed stocks or things like that. So at number 9, leveraged real estate funds or Reits. So in general, real estate is pretty safe, but the way they structure it in these funds, it's very leveraged and it's very prone to huge crashes and swings whenever there is some kind of a roadblock in the market, whether it be artificially generated through interest rates or some other factor or macroeconomic factors. These things can actually take quite a big hit every once in a while, and I think for that reason they're very risky. So number 8 coming in are small caps and mid cap stocks with profit track record. So I think the top 8 here is fairly safe to hold in your account. So if you had just Reits, I'd be a little bit worried. But if you hold a nice, diversified account with small cap and mid caps with proven profit track record, I wouldn't really be worried at this point. Number 7 is large cap and blue chip stocks. So those are even safer than the aforementioned. Not only do they have a proven track record of profitability usually, but they're also large enough to where they probably have some kind of either a moat or some kind of competitive advantage that's allowing them to grow to that size. And even though large caps can fall, blue chips can become, lesser valued. The process is usually slow enough to where most investors or some investors can catch this early enough to collect most of their money and exit in time if the fundamentals change for this company. So it gives you some time to kind of readjust and rebalance your account and maybe get rid of a company that's not going to be doing well over the next 5-10 years. Index tracking ETFs unleveraged. Now, that's some of the safest things you can do with your money, I think, and still get some decent return. You have your position spread out to 500 different positions, so you get safety through diversification. If you buy, for example, an S&P 500 tracking fund like VOO or SPY, you get basically a slice of all these 500 top companies that are all profitable. You have to have 4 profitable quarters in a row in order to qualify for the S&P 500. So you have a bunch of money-making machines. And sometimes some of them become not so money-making machines, but overall the index has been doing very well in history, and so I consider it safer than holding a few, large caps and blue chip stocks. Next on the list is foreign bonds and corporate bonds. I think that's safer than the S&P 500 even, because when you're buying debt, especially companies that is going to be buying your back, or even foreign sovereigns, then I think that's fairly safe. The risk of default is pretty low, and if you're a little bit diversified, even the risk is even lower, and it's just money in the bank. I mean, the price of these things can fluctuate, but if you're holding it for a long time, the debt usually gets repaid, so you'll be collecting some kind of money at the end of it all. Okay, number 4, gold, municipal bonds in some states. Now I put municipal bonds above foreign bonds and corporate bonds because in some states it's actually written in the law that the municipal bond holder will get their interest first before even in default. If the state can't pay for government programs, then even though it's politically incorrect, they will pay out the municipal bond holders first. And gold. I put it somewhere in there just to say. You could argue that gold is the safest asset, so you could put it at number 1, and I wouldn't fight you on it because it is a physical element that exists out in the world, and it's scarce and it's extremely useful. So you could argue. I would accept an argument that says gold is the safest thing. But I put it at 4 here just because, when you're buying it through a brokerage, you don't actually own the physical gold yourself, right? So it doesn't serve as a protection against solar flares or memory wipes or hacking or regime change and currency or stuff like that, because you technically don't have the gold in your hand. You have you have a representation of it in digital form through a bunch of third parties, so you have some third party risk, etc. And I'm only covering things that you can buy in your brokerage account. I'm not talking about physical gold in your hand. Number 3, US dollar. I think this one's pretty self-explanatory. People usually flock to the US dollar in crises for liquidities. You use US dollar for everything. It's been a very stable medium for a very long time, and there's a pretty good chance that it's going to be stable tomorrow as well. So for that reason, number 3, it's also extremely liquid, so it's traded everywhere. Everybody wants it. Everyone trades it all the time. I think it's the most liquid traded thing in the world. Maybe number 2 wins in liquidity are US bonds and treasuries. Now these are more safe than the US dollar because these are actually the money that big banks use. So they use this stuff as money. They use it to lend to each other, to repay payments, etc. Like, this is what they hold. Nobody holds US dollars. Like, no bank or big institution will hold US dollars. They'll use treasuries for cash substitute. And number 1 is complex option plays. Now you might be thinking, like, how is complex option plays more safe than everything else? Well, if you structure the options correctly, then you can actually reduce quite a bit of risk by using options. Let's say, for example, nobody would do this, but let's say that you have some kind of bond or something like that, and you do a swap, right? Basically what you do is you sell a call option, let's say, against the bond. Now that's probably the safest thing you can do, right? You protect yourself a little bit against downside risk, and you're collecting interest from the bond. You get a yield from the bond, and no matter how the movement turns out, you're gonna get some money back, and you collect a lot of the principal. So in that sense, you can use options to actually make things safer rather than increase the risk. So it's a bit hard to grasp that, but that's how it works. So there you go. The safest thing is de-risking through options, basically. Now, what else are they going to talk about? I think that's about it. So I was about to rank the account. So let's go into the Robinhood account here. By the way, sorry, I didn't explain the delta very well, but I don't know. I have a video explaining delta, and for some reason I did a much better job. I think today I was just brain freeze, but basically represents percentage move of the underlying, and the higher the delta, the closer to one, the more you know closely it tracks 100 shares of their underlying asset. All right, back on topic. So let's try to figure out. Let me rank this account. Okay, 10. Let's say 10 being the most risky and 1 being the most safe thing you can do. So most safe thing you can do if the whole account was in treasuries, all right? Or second most safe, like let's say cash, just kept the account in cash and collect some interest from Robinhood via their money market feature here. Extremely safe, right? Now let's see what I got. First of all, I'm leveraged, so that automatically amplifies the riskiness of the account. Apple is a blue chip stock, realty income REIT fund, right? JD.com is a foreign company, but they don't have much debt. They're unleveraged. Um, there's some political risk there, right? Main Street Capital, also, a fund that's I think they've used a fair amount of leverage. Visa, very solid company, blue chip. Smith and Wesson, no debt, mid cap company. Goldman Sachs, very leveraged but very good number one investment bank. So somewhat risky here. VIP Shop, no debt, foreign risk company. And Ebix, somewhat domestic company, I guess now. No leverage. I mean, there's some leverage actually. They have some debt, and but very stable earnings. I'd say mid cap to small cap. I'd say it's pretty good. So overall, without the leverage, I would probably put the account at about, because it's fairly diversified, it has like 9-10 names in it. Let's sort it by equity. There we go. So Apple, Ebix, Goldman Sachs, VIP Shop, JD. I'd put it about a 7, unleveraged, or maybe a 6. All right, 10 being just my account full of call options and pull options, put options everywhere on random things. Okay, like options on Palantir and AMC or something like that, and then put options on gold or like gold miners or something, and the whole entire account's full of that. So I guess I'd have to put it somewhere around 5. Not that risky, but because of the leverage, I would probably put this at around a 7.5. So I'd say I'm actually very risky at the moment. Ideally, I'd want to be at around a 5 or a 6, but I'm really pushing to get some gains because I feel like I've been underperforming last year, and I want to use leverage to my advantage to try to collect some extra premium, perhaps allow myself the opportunity to make some positive, um, you know, some positive, what is it called? Just gains. Get some gains. All right. Well, anyways, that's all I got for you today. A little risk talk, and look, you can't escape risk, right? Risk is everywhere. So all we can do is just try to manage it. There's even risk in just sitting in US dollars, right? There's risk in putting the dollars underneath your bed. There's even risk in just holding gold. I mean, there's always an opportunity cost. There's always risk of, losing your purchasing power due to inflation or other factors. There's risk of losing what you have electronically or physically or otherwise. So everybody has to be, on their own journey trying to figure out how to swim through this sea of risk and come out ahead. So this is what I'm doing. This is this public account, and this is how I'm managing it. I think it's somewhat risky at the moment, but then again, there's even perhaps more risk, in my opinion, in lowering the risk level of the account, if that makes any sense. And that's the judgment that I've made. So, if that makes any sense to you, I'm trying to basically slice, I'm trying to cut through the sea of risk here. And this is where I've decided to draw the line. But, everybody's going to make that judgment on their own based on, their experiences, their thoughts, what they've learned, their intuition perhaps, or whatever other instrument or tool or factor that you come up with. So, okay, that's it for today. I'll make another update, Monster Day, by the way. I'm very excited about it. Make another update probably next Sunday, hopefully even during the week. Okay, peace out.